Is the worst behind us? Are we in a new bull market? A lot of people think so. Stocks are up 15% from their lows. Bitcoin's up 50% from its lows. But I'm going to show you with data why the worst may still be yet to come, but also why that may create a beautiful wealth creation opportunity. Welcome back to the Dan Habib Show. Happy New Year, everyone. Listen, let's jump right into the content here because I'm seeing a lot of people out there getting extremely bullish on the markets, talking about this bear market being over and wanting to invest all of their investable capital right here, right now. Let's take a look at some charts at what everybody's talking about and what everybody is seeing in the market. First, the S&P 500. You could see that since we set the all-time highs back in January of last year, we've been in this pretty big downtrend, and you can see how this downtrend in orange has provided a very stiff ceiling of resistance every time we've seen these bear market rallies in the past. Well, just as of this past week, we've seen the S&P 500 be able to not only break above this level, but to close above it. And now many people are saying that this, in conjunction with the fact that the S&P is broken above its 50 and 200-day moving averages, means that the worst is behind us and that we are in a new bull market and that you should start investing everything you got right now. I want to caution against that. And I also want to caution against it in the cryptocurrency markets, specifically when looking at Bitcoin. It looks like a very similar format. Now, Bitcoin's been hit a lot harder than the overall stock market, but taking a look at Bitcoin, you can see since the highs set in November of 2021, it's also been in a big bear market, and this ceiling of resistance here indicated has proved to be very difficult, and these bear market rallies as a big ceiling of resistance, but we've literally just switched this and broken above it as of late, much like we're seeing in the stock market. And when we take a look, the S&P 500 is up 15% from its lows that we set in October. And you see Bitcoin up 50% from its lows. And just this year, Bitcoin's up 40%. So no question, off to a banner start to the year. Can this last? Are we in a new bull market? Or should we be cautious here? I'm going to show you with some data right now why I believe the worst may still be yet to come, unfortunately, but also why this may create a great opportunity for you to generate wealth. Now, you have to remember something. The Federal Reserve has been hiking the Fed funds rate, one of their monetary policy tools, to curb this rapidly rising inflation that we've seen. Now, the Fed has hiked at a record pace. Since March of last year, they have hiked the Fed funds rate from basically zero to now in a range of 4.25% to 4.5%. So they've raised the Fed funds rate by 4.25%. Again, this is the fastest, shortest time that they've done that throughout history. They've been very aggressive. Now, when the Fed does this, what they're trying to do is make borrowing certain things more expensive. Quick example for you. The Fed hikes the Fed funds rate, and this causes short-term yields in correlation to move higher. If somebody wanted to go buy a car before the Fed started hiking, let's say they could have bought the car and the loan payment was $600 a month. Well, since the Fed has hiked so aggressively, that same car, even at the same price, would now be closer to $1,000. Well, all of a sudden, you don't have somebody out there that is putting a couple keystrokes in at the bank, creating this money out of thin air. And instead, you're seeing people stay with maybe the same car that they have for longer, not making some of these big purchases. You also have credit card debt that's gone wild, but at the same time, servicing that debt has moved up and been more expensive because now the Fed has hiked rates. So short-term yields moving up, causing a slowdown in the economy. Now, when the Fed hikes, the markets will try to anticipate what that means, and the markets will react right away, but the true impact of those rate hikes is not felt for a long period of time. It could be 6 months, maybe even longer. So a lot of criticism of the Fed is this. They are driving down the road while looking in the rearview mirror. They are looking at lagging indicators, and the cumulative impact of this 4.25% raise in the Fed funds rate has not been fully realized yet. So the Fed should be thinking about potentially pausing, but yet they are beating the drum that they want to take the Fed funds rate to 5% and leave it there, leave it higher for longer to make sure inflation is quelled. But if we have not felt the true impacts of these rate hikes yet, what does that mean? It means you probably have a further slowdown to come, even though we're seeing some short-term rallies in the stock market as well as the cryptocurrency markets. Now, how about inventories? This is not a sign of strength. This is a sign of weakness. Companies have been building a lot of inventory. You can see this line. It's been on a parabolic rise. Why does this happen? Because people aren't buying their goods. Things are slowing down. And when you see a rise in inventories like this, how do companies clear that excess inventory? They have to slash prices. By the way, another factor of why inflation and rates are going to continue to come down in the first part of this year. But how about buyers themselves? This is a big recession indicator. When we look at retail, when we look at the consumer, they got addicted to this drug of stimulus. Remember, there was $5.2 trillion of stimulus given out by the government. The Fed kept rates artificially low by buying and keeping their Fed funds rate at zero. Well, now consumers, combating with higher inflation, meaning goods and services are now higher priced, their dollar doesn't go as far, but also this general slowdown in the economy, how are they getting by? The answer is they're using credit. Outstanding credit card debt's up almost 20% from last year. Look at the rise in this. That doesn't go on forever. People have limits. And remember, servicing that debt is more expensive now because the Fed has hiked. How about the savings rate? The savings rate has gone in the opposite direction, meaning people are getting by using credit and dipping into savings. The savings rate now is around 2%, the lowest since 2001. This doesn't end well. This is not a sign of a strong economy, rather a sign that the economy is going to slow further. But let's take a look at some of the different sectors and some charts and graphs to show you just how much the economy is slowing, even though it may not be reflected in some of the price action we're seeing, at least for now. Well, when you look at retail sales have been negative the last 2 months. That includes the month of December, which is traditionally a very strong month because you have all the holiday shopping. Take a look at where it was. Negative 1.1% following a negative 1.1% reading in November. When we take a look at the manufacturing sector of the U.S. economy, this has been in contraction for the last 7 months in a row. There's no question that manufacturing is in a recession. Even when you look at each of the individual markets, you look at New York, Philly, Richmond, you name it, they have all been deeply negative, showing a big slowdown in this manufacturing space. When we take a look at something called leading economic indicators, this is coming from the Conference Board. They have 10 indicators in the U.S. that they look at. This has been in contraction for the last 10 months. But one of the recession indicators that you can pull from this is looking at the last 6 months and the trajectory. And you could see how this thing has been going straight down. And if you see on this chart, there's these black and red lines here. The warning signals when it crosses over this, and then you could see once they get past this red line here, it's a recession signal. It is accurately called a recession, the last several that we have seen, and this should not be any exception. So listen, there's a lot of argument out there. Are we in a recession now? Are we headed for a recession? In any case, we may be in one now. Remember, when these are called, it's looking to history. In any case, I believe this means that we are going to see a further slowdown in the economy. And you take a look at sales of homes. Now remember, this is important to distinguish. There's two aspects of a home. There is the economic activity that is generated from home sales, and then there's housing, the investment. People get these confused, but housing activity makes up 15 to 18% of GDP, and there's no question that housing activity, due to higher rates, elevated home prices, is in a recession. It's down 18% if we look at existing home sales from last year. And when you take a look at new construction, builders are not building. They learned their lesson from 06 and 07 and 08, 09 recession, where they were building record numbers of homes when the demand wasn't there, and now they're not building. Single family starts, the start of new construction on single family homes, it's down 22% from last year. When you take a look at single family permits, boy, those are down 20% in their own right. So what does this mean? It means you're not seeing that economic activity from starting homes. You're not seeing the economic activity from home sales. This is all going to continue to lead to a further slowdown. And when these new construction jobs are done that they're currently working on, they're not doing more. You should see a contraction in the job construction job growth there as well, and see that really start to be a negative in construction jobs. But there's also housing, the investment. A lot of people take a look at the deceleration in home prices, meaning instead of being up 20% on a year-over-year basis, now, according to Case-Shiller, they're up 9.2%. They look at that and say, well, home prices are down 11%. It's the fastest decline in home prices. That's showing you the pace of appreciation. From the peak, according to Case-Shiller, home prices nationwide are really only down around 3%. I certainly don't see a housing crash, but this is clearly a slowdown in activity, which causes the overall economy to slow. Now, how about the yield curve? You've probably heard about this buzzword about an inverted yield curve. Let's break down what this means. A normal yield curve is up and to the right. What does that mean? That means as you invest your money for a longer period of time, let's say in a 10-year treasury versus a shorter period of time in a 2-year treasury, where would you expect to get a higher rate of return? You'd expect for committing your money for longer in the 10-year, you would get a higher rate of return. However, we are seeing the opposite right now. We are seeing what's called an inverted yield curve. And for the last 7 months, the 10-year yield has been lower than the 2-year yield. The Fed's favorite inversion to look at is the 10-year yield minus the 3-month yield. It's a very short-term yield. Guess what? That's negative 120 basis points right now, which means that the 3-month treasury gets you 120 basis points more than the 10-year treasury. This has been inverted for several months in its own right, and this is the deepest inversion we've seen since the 70s. Why is this important? Well, number one, take a look at the pattern. Every time you see an inversion, what do you get following it? The gray vertical lines are recessions. Inversion, recession, inversion, recession, inversion, recession. And this is one of the deepest inversions we've seen. If we're not already in a recession, this should lead to it. And you have to remember, inversions on the yield curve are a symptom of weakness and something being wrong in the economy. Much like if you got the flu, maybe you have the chills, you have a fever, you don't feel well. Those are all symptoms of the underlying problem being the flu. These are all typically symptoms of a recession and weakness in the economy. Now, how about the jobs market? Because this is really the last shoe to fall in any recessionary type period because it's such a lagging indicator. But many people are hanging their hat on the fact that the unemployment rate is very low at 3.5%. And that is true. However, take a look at every single market cycle from 1940 to today. When do we get a recession and a slowdown in the economy? It's not when the unemployment rate is high. It's when the unemployment rate is at its lowest point and begins to turn higher. And what we're seeing right now, anecdotally from companies, especially in the tech sector, is that these companies are not only laying off workers, but other sectors, they're just not hiring. But they are trying to hold on to their workers as best as possible. And instead of cutting jobs, if you look at the jobs data and you look at the hours worked, they are reducing the amount of hours of each of their employees. So that's not going to be reflected in job losses or the unemployment rate going higher. But if you look at the labor force and you look at the average amount of decrease in hours, the last jobs report, it would have showed 480,000 job losses due to this less hours worked. However, because that is not reflective the way they calculate it in how many jobs are created, that's not showing just yet. But take a look at each one of these cycles. You see the unemployment rate hit its low, begins to turn higher, you get a recession, and then it really snowballs. Every single market cycle, it is like this. Interestingly, when the unemployment rate hits its highest point and begins to turn lower, that's when you get your next economic expansion cycle. So don't hang your hat on the jobs data like a lot of the media. This is not showing underlying strength. It's showing you that something bad is yet to come. Now, once people are laid off, remember, companies are freezing hiring. Some are starting to lay people off. Once they are laid off, what happens to these workers? Well, they're not able to find jobs. How is this evidenced? Take a look at continuing unemployment benefit claims. Once you're laid off and you start to receive benefits, are you staying on those benefits or are you able to find new work? Well, you could see over the last few months, continuing claims are up over 300,000 to 1.65 million. That's a big increase showing you people can't find new work once they're laid off and they have to continue to receive benefits all at the same time while there's 10 million job openings out there. Now, I do think that number is skewed because remember, with work from anywhere, what are jobs doing? What are companies doing? They're posting the same job in all of the 50 states because they don't have to just be in New Jersey. They could be anywhere in the country, and I think that's overinflating the numbers. So here's the bottom line, team. The bottom line is I don't want you to be lulled by this recent rally we've seen in the markets. I have people asking me these questions. They say, hey, Dan, I'm thinking about investing all of my investable capital because I'm seeing some technical breakthroughs. I'm seeing people saying the bear market's over and we're in a new bull market. The other thing I'm seeing out there is people who think the market's still lower. They are holding on saying, you know what? I want to wait till the ultimate bottom. I want to wait till 10,000 in Bitcoin. I want to wait till 3,000 on the S&P 500. I would also caution against that as well. Do you know how hard it is to time the bottom of the market? Let me give you a quick example. Bitcoin hit its low at 15,500. You know how much of Bitcoin moved on exchange below 16,000? 9%. What that means is that very few people were able to actually capture the bottom or even buy at the low, because it's difficult to buy when there's bad news out there. But this gets back to the old adage that you want to be a contrarian investor. You want to oftentimes be a buyer on the most pessimistic day and a seller on the most optimistic day. But it's hard to time the market, which is why if you've been averaging in and continuing to reduce your cost basis on stocks, on cryptocurrencies as they move lower, you give yourself the best chance of success. Because again, timing the bottom is difficult. But if you continue to invest as price drops, you are continuing to reduce what that asset costs you. It's called your cost basis. And I believe we're going to see a swing lower in the stock market, in the cryptocurrency markets. It's unclear whether or not we're going to set a new low, but I don't think that this is the turning point based on all of the data that we have been showing you. And I don't think this is a safe place to just say, let me dump all of my investable capital in because we're just going to go up from here. Be cautious. Make sure to average into your investments. Continue to reduce that cost basis. And even though this is a challenging time from what I see going forward into the first half of this year in the economy, there's always opportunity during challenging times. You just have to know how to take advantage of them. It's not easy, but think about being able to reduce your cost basis on your investments and what that translates to the next bull market. Now, I want to just tell you guys, it's been great to be back with you here for this first video of the new year. And if you want to get insights like this every single day, please make sure to check us out at MBS Highway if you're a mortgage or real estate professional, or if you're a crypto enthusiast and you want to get the best crypto advice on a daily basis, check us out at CryptoCharged.com. If you use code Habib, my last name, you will get a 40% discount. You can also sign up for a free trial to either of these services to see if it's for you. Now, please like and subscribe below if you enjoyed the content today, and I'll make sure to keep you posted through this inevitable volatility that we're going to see in the months to come.